Have you ever stopped to think about how one single number, decided in some quiet meeting room, can literally reach out and affect almost every part of your financial life? Well, that's the incredible power of interest rates. So let's dive right in and really unpack the hidden lines connecting those big central banks to your personal bank account. It really does all come down to this fundamental push and pull. You've got inflation on one side, making everyday stuff more expensive. And then on the other side, you have interest rates, which decide how much it costs to borrow money for the big things. These two forces, they are locked in this constant dance that pretty much shapes our entire economy. Probably the best way to think about this is to picture a central bank, like the Federal Reserve, as someone controlling the economy's thermostat. Their entire job is to keep the temperature just right, not letting it get too hot, but also not letting it get too cold. Now, when that economy gets way too hot, that's when we get inflation. And it's a really simple concept, right? As prices for everything, everything, from groceries to gas, go up, the money you have in your wallet just doesn't buy as much as it did yesterday. Your purchasing power literally shrinks. So how do they turn that temperature down? Well, this is their number one tool, the federal funds rate. Now, you and I, we don't borrow at this rate. This is the rate banks charge each other for super short-term overnight loans. But here's the key. Even though we don't use it directly, it's the bedrock. It's the foundation for almost every other borrowing cost in the economy. And the goal isn't zero inflation, which might surprise you. Most central banks are actually aiming for a target of around 2%. Why? Well, because a little bit of inflation actually encourages people and businesses to spend and invest. The alternative, deflation, where prices are actually falling, can be an absolute disaster. It makes everyone hoard their cash, waiting for prices to drop even more, and that can grind an economy to a halt. So 2%? That's kind of the sweet spot. So when the Fed adjusts that one single rate, it's like dropping a small pebble into a perfectly still pond. That one decision creates these ripples that spread outward, and they eventually reach every single corner of the financial world. Let's trace that first ripple. In this chain reaction, it happens almost instantly. First, the Fed makes its move. Right away, commercial banks react by adjusting what they call their prime rate. That's the best rate they offer to their biggest corporate customers. And from there, it's a direct line to the cost for you to get a mortgage, a car loan, or even just use your credit card. And this really shows you how it all works under the hood. A higher federal funds rate just means it costs banks more to borrow money. And, just like any business, when their costs go up, what do? They pass those costs on to us, their customers. That's that first, most direct ripple. Okay, let's follow that ripple out a little bit further, because this is where that big, abstract policy decision really starts to hit home. This is where it affects your personal finances and the choices you're making every single day. All of a sudden, that credit card bill with the variable rate is a little higher. The monthly payment on a new home looks a lot less affordable. Financing a new car is going to cost you more over the life of the loan. So the bottom line is, more of your money is now going toward paying off debt, which means you've got less left over for everything else. This really brings us to a fundamental choice that we all face every day. Do we spend our money today, or do we save it for tomorrow? Higher interest rates completely change that calculation. They make saving look a lot more attractive and borrowing a lot more expensive, basically nudging all of us to spend a little less now and maybe save a little more for later. Think about it. Most of us prefer a steady lifestyle. We don't want these wild financial swings. So we might borrow when we're young to, say, buy a house, and then save more when we're older. Economists have a name for this. They call it consumption smoothing. But here's the catch. When interest rates go up, borrowing from your future self gets way more expensive, and that makes it much harder to level things out. Now, while these changes take a little bit of time to filter down to our household budgets, there's one place that reacts in a flash, like lightning fast, and that's Wall Street. In fact, financial markets often try to price in these rate changes before they even happen. Just picture a seesaw. It's actually a pretty good way to think about it. Generally, when interest rates go up, it pushes down on both stock and bond prices. Why? Well, for stocks, higher borrowing costs squeeze company profits, which makes their shares look less attractive. On the flip side, when rates fall, it's like a gust of wind at the market's back. Now, what's really fascinating here is the psychology of it all. When rates rise, all of a sudden, super safe investments like government bonds start offering a pretty decent return. So investors look at the stock market and they start thinking, why should I take all that risk in stocks when I can get a decent guaranteed return right here, the risk just doesn't seem as worth it. But, not all stocks react the same way. When REITs are on the rise, financial companies, think banks and insurers, they often do well because the spread they earn on loans gets wider. But when rates fall, that's a huge boost for sectors like utilities that pay big dividends, and especially for growth and tech stocks that absolutely rely on cheap borrowing to fuel their expansion. And for bonds, it's almost like pure math. It's a direct inverse relationship. So imagine you own a bond that pays you 3%. If the central bank raises rates and now new bonds are being sold that pay 5%, well, who's going to want your old 3% bond? Nobody, unless the price drops enough to make its total return competitive. That's exactly why, as interest rates rise, existing bond prices have to fall. So, after hearing all this, it might be easy to think of this as some kind of perfect machine. Turn a dial and the economy just responds predictably. But the reality is, it is so much messier than that. Using interest rates is an imperfect science, for sure, and it's full of challenges and unexpected outcomes. This quote from former Fed Chair Ben Bernanke just perfectly captures the biggest problem they have. Policymakers are forced to make these huge decisions about the future, but the only thing they have to go on is data about what's already happened. It's like trying to steer a car down the highway by only looking in the rearview mirror. And there are other huge limits to their control. For one, there are major time lags. It can take a year, sometimes even more, for a rate change to fully work its way through the economy. The impact is also really uneven. It can slam the brakes on the housing market, for example, but barely make a dent in inflation for services. And this is a big one. If inflation is being caused by a supply problem, like a war or broken supply chain, raising interest rates can't fix that. It's a tool for cooling down demand, not for fixing supply. All of which leads us to this final, really important question. For decades, we've relied on this one powerful tool to manage our economic ups and downs. But as we've just seen, it's far from perfect. So as we start to face new, more complex financial challenges in the future, what comes next? What's the thermostat of the future going to look like?